Welcome. My name is Sasha Moore, and we're here today at the Finance 15 Quarter 3 Commercial Finance Outlook live webinar. We have with us today Matthew Porch, who's the Head of Distribution at Aquamore, who'll be providing some great insights on navigating this market volatility and opportunities. So what we're going to be covering today is the new interest rate environment, the RBA's balancing act between inflation control and economic stimulus, key quarter 2 trends and some quarter 3 insights, the effect on market sentiment, and what's driving the uplift in demand for alternative finance facilities. So welcome, Matt. Looking forward to having you in the hot seat.
Thanks, Sasha. Always good to be here.
Fantastic. Well, as the name suggests, we've got a 15-minute deep dive, so let's get cracking. So I'd like to start with the new interest rate environment, and I know that most of us were expecting a rate drop recently. So understanding that the Reserve Bank remains in a very delicate position, tasked with curbing inflationary pressures without derailing still quite a vulnerable economy. Matt, I'd like to get your thoughts on this, particularly as that relates to where we're at globally as well as locally.
Yeah, I mean, I was just as surprised as anyone when the RBA didn't drop the rates. And if anybody seen my LinkedIn post, I've kind of embarrassed myself by betting the house on on an interest rate reduction. But the data, again, that was all driven by market sentiment more than anything else. Everybody was talking about it, and it shows the power of chat on the street more than anything else. But all the data really pointed to the fact that the RBA didn't actually need to drop interest rates. And I've probably touched on this in this segment before, is that interest rates are a blunt instrument that the RBA have got to manage a number of economic factors, which if they don't need to drop rates, then why should they? Because as I say, that's the one and really only tool that they've got to try and do a number of things with. Inflation sitting at 2.1% is within the target band range, and unemployment, I believe, is about 4.3%. So employment's quite full at the moment. So don't fix what ain't broke is probably the way that the RBA had a look at it and decided against reducing the interest rates. So will there be another cut before the end of the year? I guess it's anybody's guess now. You touched on the phrase normal interest rate environment. I do firmly believe that we are in a quote unquote normal interest rate environment. If you look at the sort of data before the GFC around about 2008, we were sitting at probably the same BBSW rate. It was around about 4.35. Then obviously the GFC came, which was the sting in the tail, or the tail risk if you follow that kind of risk modeling. Then again, we sort of recovered from that, and interest rates were floating around about that 4.5%, 5% before COVID, and that was your 1 in 100 real tail event. And as you're aware, interest rates got dropped to historic lows. So if you want to use the word normal, I believe that's where we are at the moment.
Well, I don't think you're alone. I think there was widespread expectation for that rate cut, and it was a very interesting moment when we did get that pause. And a lot of the media that I've been across is similar demand for an upcoming cut next week. But I think that if anything, it's showing us that the RBA is, to your point, is quite comfortable at the moment. But what I do also feel it's done is given consumers a bit of a boost in morale. So even though we haven't had a cut, a pause is still positive. Would you see it as that?
Yeah, I think it ties into an interesting point around something known as deferred consumption, which I think a lot of consumers were caught up in this street talk that there was going to be a rate reduction. And if people smell a rate reduction on the cards, it will more often than not psychologically stop them from purchasing or buying or borrowing money, because why pay more for something when if you can hold out for 4 to 6 to 8 weeks, then it's going to be a bit cheaper. that deferred consumption mindset in the mind of consumers and mortgage holders, I believe, stopped a number of things from happening. And the RBA did make some very clear messaging around, don't wait for us, go and do your own thing. And that deferred consumption mindset is starting to disappear now that this quote unquote normal is here to stay. And I think that's, I mean, if you look at July's numbers for us, I can't really comment on anyone else. We have had an extremely busy July in terms of borrowing. I think that people have realised that, and they're just starting to bite the bullet and go, let's do what we need to get done. Rates might not be going anywhere. I would be certain enough to say that they're not going up. So I think people have taken that on board.
No, indeed. And it's definitely an observation that I've had with the market. So, no, not just obviously private lending, but just really across the board, which is great.
Yeah.
So speaking of trends, let's do a bit of a reflect. I'm interested in hearing your thoughts about what some of the key trends were for quarter two, and then what might be on the cards for quarter three.
Yeah, I mean, quarter two was, in my opinion, sort of unremarkable. I mean, if we go back to sort of the interest rate discussion, and globally, you'll see that Trump's having a bit of an argument with Powell in respect of he wants him to reduce the interest rates, and you know, Powell, to his credit, is standing up and saying this isn't a political decision for you to make. It's something that we need to make based on the data that's been presented, and how that's sort of flowing into this quarter will be very, very interesting. You know, when America sneezes, the rest of the world gets a cold, is the old saying, and I guess we always need to keep an eye on sort of what they're doing. But quarter three, from an Australian perspective, the lending market appears awash with money. There seems to be new lenders popping up all over the place. Why? I'm not 100% certain. There seems to be a lot of cash coming in from overseas for yield purposes, perhaps. But there's a new lender on the block almost every second week, which is very interesting. So I guess quarter three will look a lot different to quarter two in respect of the volume of transactions that will be getting done, and the amount of risk or credit risk that's now being taken as a result of this money coming in seems to be evolving, to be fair.
Yeah, I've had I concur. I've had the same thought, and I know we've talked quite extensively offline about this influx of capital, influx of lenders is great in terms of, competition, but it also does open potential risk pending on where that funding's coming from. And we've also been talking about the market being extremely rate driven, particularly in the private lending space at the moment. So one thing on that note, I have sort of also noted that it's not really an apple for apple environment. So just with the private lending hat on, can you just provide some context in terms of, just for the brokers who are listening, the types of questions, the types of considerations that they should be looking at to make sure the rate is the actual rate?
Yeah, I mean, there's a bit of an arbitrage going on at the moment in respect of, there are some private lending rates out there, Aquamore's included, that the headline rate's actually cheaper than some of the non-prime home loan rates, and that in itself is driving a different form of activity, in that brokers are, by their very nature, and consumers by their very nature, are driven by interest rates. It's the bedrock of a capitalist society, but you are seeing private lenders with cheaper interest rates than non-prime and subprime. And as much as I hate using those terms, the second tiers love using those terms, and some of these interest rates are cheaper than the second tiers. And as I said earlier, I've never seen the second tiers take as much risk as they have in the past 4 to 6 to 8 weeks. We're seeing some letters of offer and term sheets from these second tiers where the structure of the transaction and the the risk that they're pricing in is completely skewed, and I believe that that's a result of intense competition pressure. So how that's going to play out is very interesting. But to answer your question, yeah, the brokers, again, we touch on this all the time. You just need to be very careful about who it is that you're dealing with, and um, there are a lot of low interest rates there, which can quote unquote be too good to be true, and it's just a case of figuring out exactly what that offer looks like, find out exactly who it is that you're dealing with, find out that you've found the right solution for the client, as opposed to just the cheapest interest rate that you can possibly find. And as I said, that arbitrage will drive some unfortunately poor behaviours from certain lenders out there. Some of them will be writing transactions that they probably shouldn't, that might not fit the regulations and all the rest of it. But if you're an experienced broker, you will see through all of that. So.
No, indeed. So I guess, in a market with a lot of opportunity, there is naturally risk. So I guess really the sentiment that I take of that is be opportunistic, but do so prudently and with caution.
That's right.
So
Yeah.
I also just want to touch on the types of transactions that you've been seeing come your way, because I know that quarter two is a lot about debt consolidation, particularly with the ATO's renewed focus on clamping down on any arrears. So in terms of the upcoming quarter, are you expecting a similar focus to be on that debt consolidation or that refinancing piece?
Yeah, 100%. Debt consolidation is probably the what we've seen a lot of in the past 4 to 5 weeks. The ATO being the main driver of that. We've seen some ridiculously high ATO figures, which, as you're aware, the new legislation came in on July 1st for the new financial year, and they've been more aggressive than ever. And they're putting garnishee orders out like it's gone out of fashion. They're actually putting defaults and credit notes on people's files in regards to overdue ATO debt, which has always been in their arsenal, but it's something I've never seen them use. Certainly not to this extent. And we're only on the 1st of August, right? So that in itself should show you what how it is that they're going to operate, and that will open up a lot of opportunity for lenders that want to take on that kind of risk. I think understanding ATO risk is very, very important. On the face of it, it can look like a poor character issue. It can look like business mismanagement, but again, it's more the fact that the ATO used to be a lot friendlier than they are now. Back in my banking days, I do remember that the ATO was cheaper. I think they were about 6%. And an overdraft at the bank I was working at the time on an unsecured basis was around 8.5 to 9%. So, from a cost perspective, it was cheaper just to get on with the ATO and take a quote unquote funding line with them than it was to borrow off your bank. The tables have completely turned in that respect.
No, indeed. And I know that historically SMSFs have been quite a core focus for Aquamore. Are you still seeing the interest level and demand for those types of structures?
Not as much. I think there's probably two reasons for that. Is the first and foremost reason is that the second tiers and the people that do operate in the SMSF space have done a terrific job at really focusing on that segment of the market and taking up all the eligible business. There are some really good SMSF lenders out there, Granite and Think Tank and people like that, where they have really come to the fore, and they've seen that it's a competitive marketplace, and they've really pulled their socks up, so to speak. We used to make a living off of picking up the slack where these lenders sort of let them go and didn't assess deals properly, and we were happy to pick up the stuff that they didn't like or didn't assess properly. But that's certainly not the case now. They've done a really, really terrific job, and that squeezed our margin in that SMSF space, and what's left tends to be transactions that don't work. So kudos to those lenders and other ones that I haven't mentioned. And again, I don't believe Acamore are too good at SMSF lending. And I thought I'd say it in public, but it's just the way that it is. And it's probably something we need to have a serious look at if we want to start competing with the better players again. So
Well, competition is always healthy.
yeah, absolutely.
And I know that also the type of borrower profiles continue to evolve.
Mm,
And I think that's also a really interesting thing for the brokers listening to sort of be across as well, because I know that, and particularly also speaking with your team members, the whole notion of private lending has evolved quite a lot, and really being part of a strategic wealth plan for businesses. So
mm.
just before we wrap, can you just give a bit of an overview of how you're seeing borrower profiles evolving in the commercial space, particularly for these more complex transactions?
Yeah, it's a really good question. I think the borrower profiles have been evolving for the past sort of 4 to 5 years, and that's really accelerated recently, which again, I've never seen the second tiers, not so much the banks. The banks will do their thing and they'll always have the cheapest cost of funding, and they'll always have their layers upon layers of risk management and all that sort of stuff. But the second tiers are really taking notice of the private lending space, and there are some lenders out there that are launching what they want to call private products. And I think the term private lending is becoming more and more ambiguous in a positive light than it was previously. There are private lenders that are more set up like second tiers now, and I would like to think that Acamore is one of them, where um, we could easily be considered a second tier if we had the balance sheet and the volume of transactions that we would love to have, and someday hopefully will have. But that borrower profile has very much evolved, and brokers will probably be pleasantly surprised or negatively surprised, whatever way you look at it, with the amount of declines that they will be getting off the private lenders, where previously they would have flown straight through. And that's as a result of borrowers getting better at what they're doing, the borrower profile, as you said, evolving in a positive light. Um, and very much so, you can't just dump a deal on a private lender's desk and expect it to be done now. And that's due to A, the competition, and B, the borrower profile is getting a lot better.
No, we're definitely in a more sophisticated landscape. And I think sophistication in terms of the lending products that are available, but also, as you say, businesses, I think, have evolved a lot. And I think the upside for business, and the upside of obviously the broker relationship, is there are so many ways to now construct a commercial finance deal. And I mean, we've talked about this in the past. Like, my personal view is post-COVID, or in COVID, businesses just had to completely look at their business differently. And I think a lot of the wake of that, in a positive light, is businesses being more astute, more open to alternative ideas, and more aware of their future goals, opposed to just responding in the now. But Matt, I could speak to you about this all day. Thank you so much for your insights, as always. And we're definitely in an interesting environment. It is very volatile still, globally and so forth. But I think, as we always say, we are in a great position in Australia to manage this and to always carve out the opportunity. So thanks again.
Yeah.
I look forward to seeing you next time.
Thanks, Tash.